It's interesting. On YouTube, almost nobody really explains how the 2008 crisis actually happened. People mention a mortgage crisis or a housing bubble, or they talk about unemployment afterward. But few explain the real mechanism, and honestly, I understand why. The truth sits behind layers of intentionally complex financial instruments. I'm going to explain only how the crisis occurred, nothing about the aftermath. And as you'll see, most people don't know the real cause because it was hidden behind jargon. Mortgages, MBSs, CDOs, CDSs, all designed to mask a massive extraction system. I'll simplify everything step by step. The root cause was mortgage lending and the housing market. A mortgage is simply the American term for long-term home loans, usually 30 to 40 years. You borrow from a bank at a certain interest rate, buy a house, and repay slowly. You're happy because you own a home, and the bank is happy because it earns interest. In the early 2000s, interest rates fell sharply. The government added incentives for first-time buyers, wanting more citizens to own homes. Lower rates plus incentives meant more people taking loans, more demand for houses, and banks issuing more mortgages. Everyone seemed happy. But here's the key question. Do banks want to lend to as many people as possible? Yes. But can they? Not really, because there's no guarantee everyone will repay. Yet imagine a world where banks could make guaranteed profits on every loan, even if the borrower defaults. Imagine loan profits completely independent of loan quality. If that were possible, banks would want to give mortgages to everyone, absolutely everyone. That is exactly what triggered the crisis. Banks figured out how to turn loans into profits without caring whether they were ever repaid. Picture this. I lend someone $100 at 10% interest. If they repay, I earn. If they default, I get nothing. Now imagine I sell this debt contract to someone else for $102. I instantly make $2 profit, and whether the borrower repays is no longer my problem. You might wonder why anyone would buy such debt instead of lending directly. Simple. Maybe only I am legally allowed to issue mortgages, while the buyer has no legal right to lend but wants exposure to U.S. housing. So buying existing mortgages becomes their only way in. Now enters the real scam. I'm a bank issuing mortgages. I immediately bundle and sell them as financial instruments to investment banks. I take my fee. The risk is gone. I become a commission machine. In this world, my only goal is to issue as many mortgages as possible, and suddenly I don't care about borrower quality at all, because I'm not earning from repayment. I'm earning from selling the mortgage. The obstacle is obvious. Who will buy a mortgage issued to someone who clearly cannot repay? The system needed a way to disguise toxic loans as safe investments. That is exactly why complex instruments like MBS, CDO, and CDS were invented. Banks pooled thousands of mortgages into mortgage-backed securities, MBS. Investment banks collected these mortgage pools and sold shares of them. Then they took these MBS bundles, mixed them with car loans, credit card debt, and other obligations, and created CDOs, collateralized debt obligations. John's simple mortgage was now embedded inside a giant opaque soup of debts. Then came CDSs, credit default swaps. Essentially insurance contracts that bet on whether those CDOs would fail. And the insane part was that you could buy insurance on a CDO you didn't even own, like betting on your neighbor's house burning down. Let's compress that entire journey. An American takes out a mortgage. The lender sells it as an MBS. The MBS becomes part of a CDO. The CDO becomes the basis for CDS bets, and every party in this chain collects fees while passing the risk onward. Zero risk, endless profit, until the entire structure collapses. To keep the profit machine running, banks needed more mortgages, including from people who absolutely couldn't repay. The situation became so extreme that some banks even issued mortgages to dead people. Those toxic loans were buried inside MBSs and CDOs and magically stamped AAA by credit rating agencies, who were paid massive fees by the banks selling them. Inevitably, borrowers who were never creditworthy began to default. These defaults triggered collapses in MBSs, then CDOs, then CDS payouts. Banks seized homes and flooded the market, crashing housing prices. People who bought at inflated prices fell into negative equity and defaulted too. The chain reaction brought down the entire financial system. Where were the regulators? Why didn't the government stop this? Because in reality, finance and government were deeply intertwined. During the crisis, the U.S. Treasury Secretary was Henry Paulson, formerly the CEO of Goldman Sachs, one of the very institutions that built and profited from these toxic structures. In 2010, leaked emails from Goldman Sachs executives showed they privately called the CDOs they were selling junk, crap, and garbage, even as they marketed them to clients as high-quality AAA investments. They sold worthless products and then bought CDS protection to profit when those same products collapsed. When the crash came, the financial elite was rescued because they were too big to fail. Ordinary citizens were not. 8 million people lost their homes. 9 million lost their jobs. And taxpayers funded the bailout for the very institutions that caused the destruction. So what actually caused the crisis? Greed? Lack of regulation? Bad lending decisions? Those answers are shallow. The deeper issue is more fundamental. Why were millions of Americans unable to buy a home without taking on a 40-year debt in the first place? How is it that the richest country on earth forces people to borrow for the most basic human need, shelter, while Wall Street turns that debt into a casino? This didn't begin in the 2000s. Before the 1970s, worker wages and productivity rose together. Both labor and capital shared economic growth. After the 1970s, wages stagnated while productivity soared. Corporate profits were falling, so companies demanded deregulation, weaker unions, and more flexibility. They got what they wanted. Wages were suppressed, but production kept rising. Those goods needed buyers, but workers weren't earning enough. The solution became debt. At the same time, deregulated financial markets opened the door to massive speculative profit. Debt-based financial structures flourished. When wages stagnate, when profits must constantly grow, and when consumption must continue despite falling purchasing power, the system fills the gap with credit. And on top of that credit, the financial sector builds complex instruments that generate enormous profit without producing any real value. If you want to understand why worker wages, corporate profits, and capital gains cannot all grow indefinitely in harmony, you should read the economist who wrote extensively on this contradiction.